this is a very unique environment. Unfortunately, we've forgotten the basic necessities to run a global economy and function a global economy. And now we're facing those challenges. And so I think it's going to take a long time for those trends to develop themselves. And so, yeah, it's going to be that is why I believe it's time to be allocating capital into even more illiquid assets that may take 5 years or so to perform. We're going to see a lot of M&A activity, more than any other decade that we've seen in the past, because of the accumulation of cash generated by the higher prices in commodities in general. And the need for replenishing those reserves of those businesses will force them to actually do more M&A activity as well. So yeah, it's going to be a lot of changes, but it's going to take, I think it's going to take a decade or so. If you ask me today, I think it's going to take about a decade.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Markets are in turmoil right now. So far in 2022, U.S. government bonds are down over 10%. The S&P is down over 17%. The tech-heavy NASDAQ is down over 27%, and Bitcoin is down over 37%. Today's guest, analyst Tavi Costa of Crescat Capital, thinks there's room to fall even further for these assets as everything gets repriced in what he's referring to as the Great Unwind. But there's one sector he thinks remains poised to do well, very well from here, and that's commodities. I'm looking forward to diving deep into his reasons why. Tavi, thank you so much for joining us today.
Well, thanks for having me, Adam. Looking forward to this.
I am too. We got a lot to talk about given what's going on right now in the markets, Tavi. And I want to get into all the details with you, but if we can, let's just start at our usual high level with this question. What is your current assessment of today's global economy and financial markets?
Well, I think there's a significant amount of themes, of macro themes developing all at once right now, and it's hard to get your arms around when it comes to correlations of markets have changed significantly, especially relative to what we've seen in the last 2 decades or so. I'm referring to assets as supposed to be performing as safe havens that are not behaving that way recently. Treasuries being one of them, and this is a market that has constraints on the supply side that is creating a long-term thesis for commodities and tangible assets. But at the same time, we've had this unfolding, or I call it kind of the Great Unwind of growth in extremely overvalued assets because of the cost of capital now rising, becoming more of a narrative. I think last time we talked about this was kind of a thesis. Now it's certainly now a more developed idea. And I feel strongly that this is still in process. We're still seeing a lot of the valuation of hyped and extremely crowded companies in the tech space and mega cap companies that are still to continue to be re-rated at much lower prices relative to other things that are actually profitable and making money and generating free cash flow, that are fundamental analysis becoming a thing again. The selection of investments rather than passive investments when it comes to expressing your view in a portfolio. So a lot of things to unpack, but those are the things in my mind. And I'm very worried. We had a pullback in not a pullback. I mean, 27% or so decline, almost 30% decline in NASDAQ. That's almost as much as what we saw back in March 2020. And to put into perspective, at that time, the Federal Reserve and policymakers were all talking about how to save the economy. And today, we're only talking about how are we going to raise more interest rates and reduce purchases of bonds, and in other words, reduce liquidity of equity markets and the economy in general. So it's a very, very different environment that we saw back during the COVID crash, and a bit concerning about that too.
All right. Great context. Let's continue pulling here at the line here about the market weakness that we're seeing here, right? So the markets are now having one of their worst starts to the year ever. in terms of both stocks and bonds being down this much, this far, this earlier in the year. And you mentioned there that even sort of safe haven assets like U.S. Treasuries are not performing as people expected them to right now. So we have the markets unhappy. We've got the economy slowing, right? So we had the negative GDP print for Q4. I just saw what came through on Twitter. I can't remember exactly which Fed official it was, but another Fed official just seemed to sort of float the trial balloon of like, and we might have another negative print for Q2, which would then be officially a definition of a recession. So we've got the Fed then, actively trying to dampen demand by hiking interest rates into this environment as well, and yields are rising too. As you mentioned, the cost of capital is going up here. All of those things are, they're drags on both the economy and on asset prices. So, what do you see ahead for general markets? For investors that are trying to sort of get a sense for the landscape is going here. Is the correction that we've seen so far from the beginning of this year, do you feel like it's petering out and nearing its end? Or is this something that maybe is just getting started? I mean, you mentioned earlier that you were worried. Are you worried about something that could cascade down further from here?
I am. I think this is the beginning of a bear market. But bear markets, you also have bear market rallies. And the difficult part of this is that two of the things that I have really high conviction, which was yields moving higher and equity markets moving lower, are now have had a big move recently. And so I wouldn't be surprised if we have some sort of relief rally in treasuries and equity markets from here. But the bigger trend, I think, is lower for both. And this is going to, we saw the crowded 60-40 portfolios and the risk parity strategies that also became something that has been very, very popular. Those are going to have to apply new ideas and perhaps consider tangible assets as an inflationary hedge. The dollar has been something, also a place we've been hiding very well, that I think will have other ramifications when it comes to just think about the amount of companies that make money in foreign currencies, and when you have the dollar strengthening the way it is, certainly that will have an impact on earnings and revenues going lower, not higher in dollar terms. If you look at the central bank assets today, they're actually in dollar terms, they're starting to contract. And that's a big deal when it comes to liquidity. And that's because of the dollar strength. It's not because they're selling yet, but the dollar strength is becoming a problem. And also the valuation of the bonds that they hold. You remember very well. I know I'm saying a lot of different things, but there's so many things in my mind right now. The Swiss National Bank, when they were purchasing technology companies as part of their balance sheet, and guess what's happening with technology companies? They're all unwinding now to much lower levels, and so that seemed to be a smart idea at the time, but now it's becoming very challenging. We saw crypto assets beginning to really crumble. So I'm worried. I think we're going to be in a recession soon. The question is in real terms or nominal terms. Certainly in real terms, that's coming. In my view, I think in nominal terms we still have earnings growing at about 10% in the last reports. I think that's going to drop very close to probably still a growth of about 5% or so, but we're getting very close. I mean, if you're a company, you're not growing at a 10, 15% in your earnings, you're just not keeping up with inflation. And so I think we're seeing a lot of that now in equity markets. And so I'm worried. I think we're seeing the peak of the business cycle. And unfortunately, a lot of investors are still seeing this as a buy the dip type of market. And I'm not sure that that's the case. I think that's certainly a buy the dip type of market for things like commodities. They have more, I guess, clear patterns when it comes to identifying what we are when it comes to cycles of those assets. And so and I believe that what's happening in China is also a huge deal. I mean, this is a problem, what's happening when it comes to all the issues unwinding in China. You saw Chinese banks falling apart first, and then the property developers, and now you're seeing housing market, personal mortgages are dropping like we've never seen before. We're looking at Chinese equities when it comes to technology companies. Some of those are down already 60, 70%. And the Chinese economy is in, parts of it still locked down, and some of that are easing right now. But it's, what's going to be the implications of that in a global economy when China was the engine of the global economy for many, many years. So those are the issues that I'm concerned, and clearly that's an economy that it is dependent on commodities as well, and commodities rising, inflation rising, cost of capital rising. A levered economy will suffer. So China is a great example of that. So sorry to unpack with so many ideas, but that's there's a lot in my mind, and I'm a little concerned about what's ahead of us in the next 1 to 2 years. So when it comes to equity markets in the U.S.
All right. Don't apologize at all. I think you're underscoring, a drum I've been beating, which is there are a lot of risks circulating now that encourage us to be conservative and prudent. I've sort of referred to it as a parade of horribles, and you did a good job of ticking off a number of those horrible threats. All right. So I do want to get to the point you made about how you do think it's sort of a buy the dip moment for commodities. And perhaps maybe a few other select assets, but let's hold that off just for a second here. It sounds like you think it is not a buy the dip moment for general equities. You talked earlier about how growth stocks in particular are getting hit right now, which you would expect from a lot of the factors that you just mentioned. I want to put up a chart here that you guys have put together because, Tavi, when we talked earlier, you did say that you foresaw a rotation of capital going from growth into value, and we're beginning to see the growth to value ratio come down here now. So that prediction you made, we're actually beginning to see that happening in real time here. And one could look at that and say, okay, well, great. So then maybe this is a buy the dip moment for value because all stocks are kind of getting hit right now. I don't want to put words in your mouth, though. Listening to you, it sort of sounds like, no, they can both go down together further. Just growth may go down at a faster rate than value. So it sounds like you would recommend kind of caution and wait and seeing right now when it comes to sort of general equities. Is that correct?
Look, I'm doing more of a relative trade as far as investments. I've been adding to value related investments and shorting what I think it's considered overvalued. I think there are buckets of the equity markets you should be worried about. I think there are buckets of valuation. We've seen a lot of that, I would say, manifest itself in the last 12 months or so, even 15 months, with ARK beginning to fall, and you've got software stocks. So those are the kind of valuation imbalances beginning to unwind. And then now I think the next step of this will be on profitability. Meaning profitability coming back and margins getting squeezed. So you got earnings at peak right now, material costs rising, cost of capital rising, and even labor costs now rising too. And those should squeeze margins of companies over the medium term. And so that's the other part of it, looking for businesses that will get squeezed by that. To answer your question, as we make money on the shorts, we certainly deploy that capital into value businesses that we think will do very well, or value stocks, I should say. And that majority of that capital is related to commodities. I think that the commodities market, as I've been saying, is a market that is still here to stay when it comes to the cycle. I think one of the best ways to analyze that is looking at the capital spending trends. That is really what the whole cycle of commodities is predicated on. And clearly, when you look at capital spending or CapEx for commodities in general, adjusted for GDP, we're at least at a 20-year low today. So I think there's a lot more to go once we see those companies producing more of those tangible assets, increasing supply. and really see reserves increasing drastically from here, which will take years to develop as well. I think that will be the time I will change my mind. We're so far away from that I think it's if I have a portfolio is really, I'm extremely long inflationary assets, long tangible assets and commodity producers. And then I have to think about how do I hedge that position with shorts in equity markets and long the dollar in different parts of the world that I think will have the recipe for major devaluation of currencies. And we have to think about that those large developments happening right now will create a lot of volatility in FX markets, something we haven't seen in the last 2 decades or so. In the 90s, we used to see depeg of currencies, and China had to reset the monetary system 9 times in the last century, and we haven't seen any of that in many decades. And I'm referring to not Venezuela, not Argentina, not Brazil, not Turkey. I'm talking about even larger economies and more developed economies, including China in that stage that need to have some sort of reckoning when it comes to their resetting of their monetary system, given the fact that the imbalances are not in line with the value of those currencies. And at some point, given what's happening with the disruption of commodity markets and other parts of yields and other things, I think that will start to challenge some other parts of the FX market. So we'll continue to be short. The only way we do it is reduce our shorts. I mean, they reduce themselves as they work, and then we put the money to work into tangible asset related investments. And so I think that has been very successful so far this year, and we'll continue to do that over time and continue to look for opportunities on the short side too.
Okay. God, so many things to follow up on here. But one point you made, I just want to kind of underscore, and would love you to chime in briefly on it, is yes, we had the dot-com bust and we had the 2008 global financial crisis. But kind of the type of turbulence and systemic scramble to kind of reform things that aren't working. You talked about China basically changing its monetary system several times in the past century. We've had this relative tranquility for the past 20 years, and I would say kind of a false tranquility because of all the intervention that's been going on by the world central banks and whatnot. And it was punctuated by the dot-com bubble bursting and then the 2008 crisis. But we've seen a lot less of what you were referring to in the past 20 years than we had sort of seen on average before. And my point here is we kind of have this generation of investors that probably has difficult imagining the instability that we used to see in the past globally, and may very soon get sort of educated about what reality really is more commonly like, but they have a hard time imagining it right now just because they haven't seen it in their investing career. I see you nodding a little bit as I'm saying this, but do you agree?
I agree because it's I think it's all linked, and certainly we saw this issue with let's just step back a little bit. I mean, the issue with commodities, when you look at the capital spending trends, that was the case way before the pandemic. We just didn't know what would be the trigger to make things change. And why am I referring to this? Because it's all linked. When we had the pandemic crisis, the shock on the supply constraints caused commodities to rise. When commodities began to rise, you had this inflationary headwind, or I should say a tailwind on inflation. And inflation is a problem we haven't really faced in many decades. It's been a cyclical problem. When inflation began to really become an issue, you start seeing social unrest is one of the issues that you begin to see. And the second problem has to do with that could be linked to this is geopolitical issues too. And so certainly we were in a much more globalized environment. Now we're entering a more deglobalized environment that will set off a lot of other themes and ideas. Companies that will be forced to bring back their manufacturing to the US. We're going to see known residential construction happening in developed economies as a result of that. That should be the other driver of tangible assets that we see construction happening. But going back to your question, investors have not really are not used to this market regime that we're seeing, and that's absolutely normal. Maybe some emerging market investors are more used to this, and I would include myself into that. But it's interesting because if you analyze Brazil, for instance, as a place, just for a second, Brazil is a place where fundamental analysis has always been a thing for the last 3 decades or so. That you can analyze companies that have performed well in Brazil, or companies that actually have a lot of value principles embedded to those investments as a way to support that as an asset that should perform very well. And so profitability always matter because cost of capital has always been higher than other places. And so you always have to think about how to make money. Developed economies have not suffered through that. So cost of capital has always been suppressed over the last 2 to 3 decades. And so they're able to focus more on growth and other aspects of their businesses. And so now that's shifting because we're seeing developed economies suffer from cost of capital rise. And that's going to be a change. And so fundamental analysis comes back. Is the selection of securities is a very important aspect of it. I mean, just think about Adam, the whole the amount of folks actually go into quarterly calls in earnings calls. And engaging with those. I mean, we're probably at a record low of amount of people going to those because no one is doing fundamental analysis. We as a fund, I always comment that with Kevin. I mean, it's extremely difficult to find folks that have a background of fundamental analysis nowadays. I mean, everyone is a technical analyst. Everyone wants to talk about crypto assets and technology and software, and that every new company is going to be the next Google or Amazon. But the market doesn't work that way when you don't have excessive liquidity anymore. And I think we're entering a world like that, just like what we saw in the 70s. And then people get confused. Oh, but how is this the 70s? We didn't have as much debt. Well, that's not from that perspective. It's from the perspective of market leadership, where growth is not a priority anymore, but profitability becomes a priority. And quant funds cannot find granularity when it comes to data to go back to the 60s and 70s to navigate the space today. So this is a new environment for a lot of investment approaches. And that's why I think fundamental analysis will come back to become this resurgence of fundamental analysis in general will be very important for investors, and will reshape the way the market will look like in the following years too. So I mean, it's exciting in a way, but at the same time, it will be painful in other parts of the market too.
Yeah, and to my point, I think yours, it's going to catch a lot of today's investors by surprise because, to your point, they're used to playing a different game, right? The rules are changing, and they're used to playing by the old rules. All right, so let's now move on to commodities. It seems that's where you continuing to place the vast majority of your focus. As we leave just sort of the general market, I want to recap here real quickly. Sounds like you are looking for continued weakness ahead. Growth will probably be more weak than other stocks, but in general, it looks you're expecting the general equity markets to continue to remain weak, we'll say. And we're going to go into commodities in a minute, which it sounds like that's where you see the biggest opportunity. Right as we leave, though, are there other current sectors in value that you are actively deploying capital in right now, or are you pretty much just focused on commodities?
No, I think there's 2 parts of the equity markets that look appealing to me. One of them is our defense stocks, and the second one has to do with companies that are related to construction and engineering in order to bring back manufacturing to the U.S. So I'll give some data in both of those if you're okay with that. So
yeah, please.
Defense spending used to be close to 9% back in the 60s of GDP, 9% of GDP. Today we're about 3.5, 3.3%. I think that back in the 40s, it was even higher than that. It was 40, 50% of GDP sometimes. And that military spending is in my view going to come back, and the geopolitical tensions rising. And this is just looking at the U.S. solely. So the defense industry makes in revenues today in aggregate somewhere close to $250 billion. If we think about just going from 3.3% of GDP to somewhere close to, let's just double from here, about 6 to 7%. We're talking about unleashing somewhere close to $1.5 trillion of capital coming into this industry. Not everything will go through those defense stocks, but the majority of that could go to that. And if we're talking about 4 to 5 times how much money they make on an annual basis, and those are annual spending of defense spending, by the way. So that's on an annual basis. And then you extrapolate that by thinking about the NATO countries that will also be spending more on defense, which I think it's plausible too. And I think we're going to see that. And those economies don't have those industries as well established as the U.S. And so a lot of that weapons and materials in general that are and services that are generated through this industry in the U.S. I think will benefit tremendously in the future. Another thing that will be interesting will be manufacturing. Manufacturing today accounts for about 10% of GDP. Back in the 70s and 60s was about 30% of GDP. And so I think we are in an upper trend of bringing back manufacturing to the U.S., and other developed economies will feel the same pressure from companies. It's very difficult to think of a company today establishing their business in the U.S. To create a relationship with China as a manufacturer plant of their product for the next 5 to 10 years. And so I believe that we're going to see that shift in a large way. Companies like Apple may suffer from those shifts. Companies like Apple have certainly benefited from globalization, low cost of capital, and especially this relationship with China, which was okay for the last decades. And now we're seeing that shift that maybe started with Trump, and now it's accelerating to the downside here. And so a lot of things again to unpack on this, but it's I think that we'll set again a second wave of demand for commodities as we see this infrastructure being rebuilt here in the U.S. in order to provide and feed the needs for those businesses to produce their goods and services here in the U.S. and so in other developed economies. And so I think they're going to be unleashing even more macro related ideas, and one of them I think will be construction companies, cement businesses, and engineering companies, and along with the defense spending. And so that's all linked to as well fiscal spending. Fiscal spending relative to GDP will be higher as part of this, as the government should also play a role into that.
Okay, great, thanks. So defense, infrastructure, construction, and manufacturing, and expect your iPhone to get more expensive.
I believe so, yeah.
All right. So now let's get to the main event here, which is hard assets, commodities. It's where you're placing the majority of your focus. It's where you're deploying capital right now. I heard you say earlier, it's one of the places, given today's asset prices, that you are still buying actively. Let me just set the stage a little bit here, which is we've talked about the slowing economy. There's a chance that we could be going into recession. It sounds like you believe we're going to. I believe as well. In theory, that leads to lower economic demand, lower economic activity, and one could make the argument lower demand for commodities. And we have seen the prices of commodity producers largely come down over the past month or so, with sort of the general market correction here. And so the big question I think most viewers of this channel are tuning in to see you opine on here is Tavi, is now a good buying opportunity, right? Have good values just become even better values over the past month or two? And is this a good time to buy in, or should we wait and see a little bit? Sounds like you think that there's plenty of good value on the table right now.
Yeah, I do. I mean, if you can you can look independently into each part of the commodities market. But I think energy companies, for instance, so when you look at free cash flow yield today, is one of the cheapest we've seen in history, even despite the increase in prices that we've seen from those stocks in the last year or so. You look at agricultural commodities, it's one of the most bullish technical charts I've seen. And I think that trend is still going to go significantly higher. You look at CapEx trends for those businesses are also very pronounced when it comes to, we should be setting up to those companies and assets doing very well. Base metals, you think about, close your eyes for a second and think about if you're locking down one of the largest economies in the world, what would you think it would happen with a cyclical commodity like copper? Now open your eyes, and what you see is that copper did not collapse as much as you think it would collapse, and that's because of the supply constraints. Certainly, allow the metal to perform better than most people would believe, and so there are no shortage of issues from the demand and cyclical downward pressure that we may see here, but it's incredible that the supply side is so tight that I think you will still see those commodities to perform well. We have a basket of those.
Hey, and Tavi, I'm sorry, can I interrupt just to make one point, and then I want you to continue, which is when you've been on this program previously, and so funny, we haven't really even mentioned the Ukraine war yet, and that's a whole other factor that's impacting things here. But when you were on earlier, you were saying, look, irrespective of what COVID did to supply chains, and now irrespective to what the Ukraine war may be doing to them and the embargoes of Russia's supply and stuff like that. Earlier, you used a term, I think the capital allocations in this space or whatever. And I think what you were referring to, which is what we've talked about in the past, is if you look at the past decade of capital going into most commodity sectors, it's been much less than had historically been entering the space, and setting ourselves up for these sort of structural deficits of these key commodities. And so I want you to just clarify or opine for folks real quickly on this, which is where we are today. We are experiencing shortages, or at least tight supplies in a lot of commodities because of investment allocation decisions made 5-10 years ago to not invest in the CapEx of this space. Then that gets exacerbated by the COVID and the Russia war and Ukraine issues. So am I summarizing this accurately? Which is, I just want to set the stage for folks that you're not just excited about what's happening today in commodities. You're excited because of what happened 5-10 years ago, correct?
That's right. I think we've seen a bear market for commodities since 2011 or so for majority of commodities. And so, the trend is that corporate management has been extremely conservative, and especially when it comes to exploration budgets, when it comes to M&A activity, when it comes to putting capital into something that doesn't generate free cash flow. I was just looking at the trends of production of commodities during bear markets actually tends to increase because, producers are just not very smart in general. I mean, it's interesting. They tend to act in kind of a desperate mode a lot of times. And so it's very important to watch those fundamental trends of the industry. And then you have the ESG policies that kind of developed slowly and becoming more and more of a constraint when it comes to allowing companies to invest capital in different parts of their businesses. And so, I think a lot of people end up focusing too much on the triggers when actually you should focus on the overall environment before those triggers happen. And certainly we have the same happening, for instance, on let's just say one thing that hasn't yet happened, that we haven't seen the trigger: gold and silver. Gold and silver, when it comes to the just the same analytical work inside of the industry looks the same way that oil companies and agricultural companies looked 2 to 3 years ago. But we had a trigger that ended up causing those commodities to start moving. We haven't seen that yet in silver and gold, even though they have gone, I would say relatively sideways for the last years, not the last 15, 16 days, but for the last few years have been kind of a sideways market. So and no one is focusing on the underlying thesis behind it, but mostly focused on what is the trigger that makes that happen. And I think it's important to accumulate assets prior to that trigger when or identify throughout history that those factors tend to certainly create real big bull markets and sustainable bull markets that tend to last over many years, as the sustainable word would imply. And so I think we've seen a lot of focus on the pandemic, a lot of focus on the geopolitical issues. They certainly accelerate those trends, but the problem is much deeper than that. And as you know very well, even finding professionals in the labor constraints of finding competent folks to run exploration and development and production companies in natural resource industries is already a scarcity on its own. And so, how do you fix that? Those things take time to shift. Usually you see capital coming in first, and the capital tends to allow those businesses to pay better salaries. And then you start seeing the labor trends begin to change as well. And, you look at geosciences enrollments for undergrads and graduate programs out there, they are in a secular decline as well. So there's not a lot of interest in geosciences today. So all that is playing an important role into the problems that we have right now that will take, in my view, years, if not a decade or so, to unfold as far as the price of those assets continue to go higher due to those supply constraints.
All right, great. So just to summarize, the commodity sector is going to have a tailwind behind it for at least another decade, it sounds like what you're saying, because of the structural, both capital underinvestment and human talent underinvestment in this space.
Look, I think that's going to be the case, but I can change my view about the timing, because all the factors that I'm mentioning will change over time. And if I see 3-5 years from now, CapEx is not a peak, of course, I'm going to change my opinion. But knowing this industry and knowing the current political constraints we have, I think this is going to take a lot longer than most people believe. And I've said this before, but just think about what's happening with energy today. Oil prices, just call it at about like $100 a barrel or so. Every time in history we've seen oil at those prices, the industry of energy in general was booming. The sector was booming. People were trying to get into those businesses, is trying to work for those companies. We're seeing the opposite trend right now. A lot of geologists are trying to leave energy-related companies because they don't think those companies will be in business in the next 5 years or so. And so this is a very unique environment. Unfortunately, we've forgotten the basic necessities to run a global economy and function a global economy. And now we're facing those challenges. And so I think it's going to take a long time for those trends to develop themselves. And so, it's going to be that is why I believe it's time to be allocating capital into even more illiquid assets that may take 5 years or so to perform. We're going to see a lot of M&A activity, more than any other decade that we've seen in the past, because of the accumulation of cash generated by the higher prices in commodities in general. And the need for replenishing those reserves of those businesses will force them to actually do more M&A activity as well. So it's going to be a lot of changes, but it's going to take, I think it's going to take a decade or so. If you ask me today, I think it's going to take about a decade.
Okay. And Tavi, we'll be having you back on regularly to allow you to make audible, iterations to that call as you see data as it develops. All right. So I want to get to the, specific sort of investments that you are making right now in the fund, whatever you can share. And then I want to pivot and talk specifically in some depth about gold and silver. So real quick before I ask the question about what are you putting your money into right now, one question that's come up a lot is, and you referred to this a little bit, so inflation's raging, right? So we're seeing input costs go up, energy, labor costs, et cetera. How material is that to commodity producers? Are they, is it a huge part of their cost structure? Is this really going to hit producer productivity, or is it less of a concern?
No, it is material, and we are not allocating or deploying capital into producers, but I follow very closely. They're making more capital or generating more free cash flow than ever done in the history of their businesses. But certainly they have been impacted recently. Gold and silver miners, for instance, I was just looking at a trend of cash flow relative to gold prices, and we do see a little gap, meaning they're not making as much money as where gold prices are today. It's not a major gap, but it's a gap. And certainly that's the case in other industries too. Energy is a little less, but base metals and metals in general, precious metals and base metals companies are certainly suffering more from that. I think that those issues with labor cost is something that the overall market will have to face. And so you have to think about in relative terms, number one. And I think commodity businesses will have a better setup relative to, let's say, a software company when it comes to, and we can get into that. There's another theme on software and other technology companies about the way that they pay their employees, and I think that will shift as well. But I want to focus on commodities for now. But yes, I think that those are important parts that may actually damage some of the producers, and this is why I think most of the exploration assets that have metals in the ground and have the leverage to the physical price of those commodities should perform even better than the other parts, particularly right now. And so, I have been wrong on this.
Because energy and labor is sort of a smaller fraction of their overall cost structure.
That's absolutely right. It is a smaller fraction, especially energy costs is a smaller fraction of exploration companies when it comes to, compare that with the open pit production in gold and silver, relative to exploring a ground in Nevada, will cost you much less. And so Nevada, thinking about even places that are expensive to explore. But I think what we have today is a setting where the companies at some point, those businesses that are looking for generating free cash flow, depleting their reserves, will at some point need to replenish those. And so I think we're going to enter an exploration age. That's another theme, and something we haven't seen in many decades. The majority of exploration investments we've seen in the past were mostly focused in already existing assets that we had, and so they're not new greenfield projects. And now we're seeing, at least we've been financing and funding a lot of those new projects in different parts of the world. I think we're going to see a stream of new assets coming along in the following years, and that's our hope as an investor of many of those companies to develop new reserves of different minerals in different parts of the world. And so I believe strongly that the production companies will perform well too, but I think that those will face some challenges when it comes to labor costs and other problems, even more than the other parts of the industry. So those and perhaps Adam, something just to that is related to all this, for folks that are worried about the supply constraints. Think about this for a second. We're about to pass about a $40 billion bill to help Ukraine. $40 billion. That is exactly how much the E&P companies in the oil space has spent in the last year in CapEx, just to put into perspective. $40 billion. Wow. I think at some point we will see the government getting involved into this. There are deposits in different parts of the U.S. even that are not economically viable, but could become economically viable if the government pours capital into those projects and help them to become viable. And so we may see that. I think that's that type of effort will actually will become relevant in the future, just because of the needs for those projects to be developed as soon as possible. And so, but that really puts into perspective. I mean, $40 billion. I mean, back in 2008, they used to spend over $150 billion or so. So we're about 3 times more than what we have today. So we're spending today. So with a much larger economy globally. And so, this is as constrained as it gets from any standpoint that you look at in the industry. But I guess that's a good data.
That's a great data point that shows that the likelihood of the pendulum to just have to swing back. All right, so let's get to that question about what are you actively adding to your portfolio right now?
Well, we've been adding to existing positions that we have. This is one part of it. We've been fortunate to be making money, especially in our global macro fund on shorts. We've made a significant amount of capital in our CNH shorts. So their Chinese yuan shorts have worked very well. And so that allowed us to have cash, a lot of cash. And then so we've been using that to buy some of the current investments we have in different parts of the world, Golden Triangle and Nevada. We've been adding to our businesses in Newfoundland, even some parts of Europe as well. But those are, I would say, the big bulk of the investments we made recently. We've been looking for new investments too. We've added a new investment in Australia. Maronan Metals is an interesting company. It's a silver, more of a silver related asset, which is a huge focus for us right now. We've been adding to precious metals as much as we can in this pullback too. And what we find here, Adam, is that things, some of our themes, it kind of, we see some of our themes working and some others not working. So we kind of have to rotate into themes that have not worked recently. So certainly precious metals has been something that's been lagging. So we've been getting out of some of our shorts and putting back that capital into things that have not worked, that we still continue to believe strongly. We've got over, I would say about 40 core investments in our precious metals, but overall we've got over 80 to 90 companies in the portfolio, but 40 or so are more core assets that we wanted to have over 20% of those businesses. And we continue to accumulate as much as we can, because we believe strongly that the next 5 to 10 years, gold and silver prices and other commodities will be significantly higher from here. But precious metals has been a big focus recently. We've added a lot to agricultural commodities too. So certainly did that today and yesterday as well. And are you buying so both in agricultural and energy, and I'm zeroing in on the non-precious metals ones because we're going to dig into those in just a second. Sure.
Are you buying exposure to the base commodities themselves, or are you buying more sort of, producers, explorers, et cetera?
We buy the producers on that camp, but we also buy some of the physical metal. I should say not physical, but I should say in the futures market. On agricultural, we own more of the commodities. We have some fertilizer businesses and some other companies that are related to those. But yeah, we've been adding to those. And oil.
Okay, I'm sorry, but you comfortable sharing which commodities you're adding to currently?
No problem. If we have a basket of agricultural commodities, so we've got corn, we've got beans, and we got wheat. Wheat had a very big pullback recently. We've been adding to gas, nat gas here in the US. We've been buying E&P producers, some of the companies that score very well in our quant models. It's interesting because our quant models have a lot of value principles. And so we're seeing that a lot of the companies that are suggested by that model have been performing very well because of the shift in the markets. And so we expect that to become a even more relevant tool for us. But that's a plus. And we've been using that model to select some of the energy companies that we've been buying. One of them I'll mention is Matador. But there are other companies we've been buying in the energy space, the big cap names as well: Chevron, ExxonMobil, Valero. So bought some refineries. But yeah, we've been very, very, I wouldn't say, we've been very actively buying in this pullback. And I think most of those commodities, I mean, today is easier to say, because at least before this interview, a lot of those companies are doing very well, but the last few days has been brutal for those investments. And so I think it's a great opportunity to be buying the dip here.
Okay, great. Thank you. I know people like me have been furious taking notes as you've been talking there. All right. So let's now turn towards the precious metals. You've mentioned several times here that you think there's great opportunity there. Sounds like you said that you are shifting even more of your capital right now into the precious metal space. So let's dive deep into the opportunity you see there. But maybe first, can we just talk about how, after hitting an all-time record high in March, gold and silver have basically kind of been on the escalator down since. So what's causing the current weakness in the underlying precious metals themselves?
Well, I think
this interview with Tavi will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it, which has taken a while because it has a lot of charts. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as the little bell icon right next to it. And be sure to hit the like button too while you're down there. Last, if the sobering market outlook Tavi has detailed in this interview has you feeling a little vulnerable about the prospects for your nest egg, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the risks and trends that Tavi's mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with Tavi Costa.